Stocks slide, dollar gains on hot U.S. inflation statistics. New York global equity markets slumped and the dollar reinforced on Friday after a bigger-than-expected U.S. inflation spike in May raised worries the Federal Reserve can also tighten policy for too long and cause a sharp slowdown. The U.S. Purchaser Charge Index elevated 8.6% ultimate month, the most important year-on-year growth since December 1981, the Labor Department said. Economists polled by had expected CPI to upward push 8.3% yearly. Many economists and marketplace individuals expected the information to expose inflation had peaked, but gas fees hit a record excessive, the price of food soared and condo expenses surged. It was quite warm. This report indicates that underlying inflation pressures remain pretty strong, stated Aichi Amamiya, senior U.S. economist at Nomura. The dollar rose to a close to 4-week excessive against a basket of currencies, whilst U.S. Treasury fees tumbled and quick and intermediate dated yields hit their maximum ranges in more than a decade. 2-year yields, that are enormously touchy to fee hikes, spiked to a few 0.5%, the very best when you consider that June 2008. Stocks on Wall Street and in Europe fell greater than 2% as traders feared vital financial institution efforts to manipulate inflation might be so harsh it might slow growth and squeeze corporate profits. The Pan-European Stoxx 600 index fell to 69% and MSCI's gauge of worldwide fairness markets shed to 79%. On Wall Street, the Dow Jones Industrial Average fell 2.73%, the S&P 500 misplaced 2.91% and the Nasdaq Composite dropped 3.52%. The three indices published their largest weekly declines since January, tumbling roughly 5% each. The S&P 500 is now down more than 18% from its January 3 document remaining top, a drop that once more puts it near to confirming a endure market as described with the aid of a 20% drop on a closing price foundation. The stronger-than-expected CPI information has changed the calculus for what the Fed does in September after, maximum assuredly, raising fees 50 foundation points subsequent week and in July, stated Art Hogan, leader market strategist at National Securities. Analysts at Barclays, Lon, BARC, and Jefferies now anticipate the Fed to deliver its first 75 foundation factor boom in 28 years subsequent week. Fed price range futures buyers assume the Fed's benchmark price to growth to a few 0.69% next May, from 0.83% now. The Fed nevertheless has a chance of engineering a softer touchdown as there may be mounting proof a slowdown is happening, said Reese Williams, leader strategist at Spouting Rock Asset Management. At least in the product's economic system, there are signs that call for a sincerely slowing, Williams said. Houses are in the marketplace lots longer, car sales are not so hot and delivery charges have collapsed coming from Asia to here. Japan hints at yen intervention concerns also set up approximately demand and increase in China, the world's second large street financial system, after Shanghai and Beijing imposed new COVID-19 lockdown regulations. The yen rose off 20-year lows after Japanese policymakers made rare remarks approximately its weak spot. Japan's government and crucial financial institutions said they have been involved by using latest sharp falls in the yen in an unprecedented joint declaration, the most powerful warning to date that Tokyo should intervene to help the currency. The yen has been plumbing 20-year lows against the dollar and 7-year troughs against the euro on expectancies the BOJ will retain to lag different important banks in exiting its stimulus coverage. The Japanese yen later weakened 0.05% at 134.41 consistent with dollar. The dollar index rose 0.852%, with the euro down 0.9% to $1.0519. Overnight in Asia, MSCI's broadest index of Asia-Pacific shares out of doors Japan fell 0.9%. Continued strong shopping for via foreign traders and cautious hopes of regulatory easing on tech companies lifted China stocks, in spite of lockdown indicators. China's blue-chip CSI 300 index turned into up 1.5%, while Hong Kong stocks trimmed earlier losses to stop off 0.2%. Oil fees fell on concerns growing prices will pressure clients to cut call for, and as China imposed new COVID-19 lockdown measures. U.S. crude futures fell 84 cents to settle at $120.67 a barrel, and Brent settled down $1.06 at $122.01. Gold costs rebounded strongly in risky trade as consciousness grew to monetary risks of extended inflation. U.S. gold futures settled up 1.2% to $1,875.50 an ounce.